Hi everyone, welcome back to Paisa Bolta. It's just me today. Shashwat is busy, Anand is busy. Kesav seems to be doing something else today, so I thought I'll just catch up with you with some interesting news which I've been reading about. The main thing which I want to talk about is central banks and what they feel globally in our developed countries and emerging markets, what's happening with their central banks and the implications, what's going forward for the next 6 months at least, with the election cycles looming in India and in the US, what to keep an eye out for. The economic activity globally has been slowing down. Inflation seems to have kind of, if not started to trickle downwards, is holding stable. So a lot of central banks across the globe have stopped raising their interest rates. So what does that mean? When you stop raising the interest rates, that means the banks are pausing to see if the long-term implications of having higher rates, what it's going to do to the economic activity. Because the problem when you raise interest rates is, yes, you have tamed inflation, you start cooling inflation down, it starts leading to disinflation, as they say it. But the flip side of it is you start choking the economy. When free cash flow was happening, a lot of economic activity was happening because a lot of credit, as they say, money was flowing in the market. It was easy to take a loan, it was easy to repay your loan, and loans were not so stringently looked upon when they were being awarded, nor they were being stringently looked upon when payments were being delayed or slowed down. But now, because of the interest rates going up, the EMIs which we are paying, the cost of the loan borrowing has been going up. Banks are looking at more keenly and they're being more strict about this in giving money out and issuing fresh loans. So this kind of chokes the economy, as to say in a layman's way. So this choking of the economy slows the economic activity down across the board, across the globe, in all the countries, as you can see in macroeconomic activity. So the central banks in the US, UK, Japan, Switzerland, all of them have started halting the interest rates increase, while emerging markets such as Brazil, Chile, Hungary have even gone to the other side of starting to cut interest rates aggressively, meaning liquidity is being flushed back into the market. So what does this all suggest? Falling economic activity and the weakening of economic activity, central banks are signaling of a more cautious approach. They're not keen to raise interest rates. They do want to make sure that the inflation, which they have been working so hard to control, is finally controlled. Because more than economic activity, the central bank's main goal is to tame inflation. They want to curb price rise. And with the oil going the way it's going, bubbling near $100 and more, they are worried that it will further spiral inflation, especially when we get into the winter months in Europe and in the US. So they want to keep an eye out on this, and they don't want to cheer too early and start saying, yes, we have cooled inflation, we don't have to worry about inflation. So that's why the next 6 months period is going to be very crucial. So this is something to keep an eye out for. When we're talking about this, there's something else also which I want to talk to you about. So what does it mean when we raise interest rates as in a corporate environment? When you start raising interest rates, the cost of borrowing and your debt starts rising. So this whole notion of buying shares back for companies becomes less and less appealing. If you had seen a couple of cycles ago, before the interest rates were to the point they were risen, a lot of companies in the US and across the globe, even in India, were thinking of rewarding shareholders with share buyback. When you do share buyback, it is one of the ways where you can avoid tax implication, and the company can reward investors by increasing the share price by extinguishing shares. But that has also led to the company's borrowing costs going up. So the companies are now find it less appealing to do this. So with this happening in the US, post-March, most companies have stopped doing the share buyback, and more of them are keen on issuing dividends. And there's a regulatory tightening also happening in the US, where these share buyback are falling under scrutiny of tax implications. So now it's not as appealing as it used to be. Even in India, prior to 2019, share buyback was one of the ways companies were offering incentives to investors. But even in 2019, the Indian government decided to start taxing it. So even share buybacks in India started becoming taxed heavily. So even that has been less appealing for Indian corporates, which is about the same suit, which is what's happening in the US. So in short, buybacks was once looked upon as the king of stock, which in short, looking back, stock markets, looking back, in short, companies in the US across the globe were looking at what you call buybacks as an opportunity to incentivize shareholders and investors. That seems to be an abating trend, and not many of them are keen on doing this anymore. And dividend seems to be the way they are rewarding their investors going forward, especially in Europe. As an investor, these are things which you can look at and consider which companies are offering buybacks, which companies are offering good dividend yield, things to consider for the next 6 months at least. As interest rates seems to be holding on to this stable rate, we cannot expect this to be stable either way. If inflation is cooled and inflation is tamed, maybe we can, after 6 months, see some movement downwards, which is what a lot of the bullish people in the market are expecting, and we're very buoyant. If that does happen, we'll see a lot more FIIs inflow into India, and that's where we see this huge uptick in the Indian stock market, which a lot of people feel will happen. We're even pushing the Nifty up to 25. In the other hand, let's say inflation is not tamed. Let's say we have a very severe winter in Europe and oil prices keep going up. Even with the interest rates being held, we see inflation still creeping upward. We'll see central banks reversing back and raising interest rates yet again, trying to tame inflation. Again, this would further pressurize FIIs to pull funds out of India, again knocking the wind out of the sail in the Indian stock market, and maybe we'll see a downward trend. These are the two ways which the market can play out. That's why it is important to keep in a macro level what is happening with inflation and how the central banks are reacting. As of now, the developed countries are all holding their interest rates, which is Switzerland, US, UK. If you look across the board, all of them have voted. Even in the UK recently, it was a very marginal vote which managed to hold the interest rate. Otherwise, they would have had 15 rate hikes in a trot, where they've stopped it with a record 14 right now. So keep an eye out on the macroeconomic side, what is happening with inflation, with central banks. While emerging markets already have started cutting rates like Hungary and Chile, as I've said before, we have to wait and watch to see what happens globally. This is how the play is going to be for the next 6 months. So as you move your investments around, this is something to keep your eye out on. Thank you for watching me on Be Rich today. I know this video was a little shorter than what we usually do, but I just wanted to step in and give you some information about, on the macro level, what is happening with interest rates and how to watch these interest rates in India and globally if you're looking at it. And I also want to talk about share buyback and versus dividends. Is share buyback good, or is dividend good? At the end of the day, matters to your personal opinion on how you play this out and which company you're targeting and looking at. Thank you for watching the program today, and I'll see you on the next one soon.